Freddie Highmore is the star of The Good Doctor, a bright spot on ABC, where we've had some disappointments, Disney's chief executive, Robert Iger, said. Leanne Hensherich, via Associated Press Los Angeles, the Walt Disney Company reported weaker than expected quarterly earnings on Thursday, partly because of bleak results at ABC, an animated feature film that ended up on the shelf in light Cars 3 toy sales. Disney shares fell 3% in after-hours trading, but recovered and ultimately increased after the company announced the beginning of a new trilogy of Star Wars films. Disney-owned Lucasfilm said Rian Johnson, the director of Star Wars The Last Jedi, which is scheduled to arrive in theaters on December 15, would shepherd the series, introducing new characters from a corner of the galaxy that Star Wars lore has never before explored. Fresh details about the exclusive programming that Disney has planned for a Netflix-style service also perked up investors. That service, scheduled to arrive in 2019, will include a live-action Star Wars series, a new installment in the High School Musical franchise, and a show based on Pixar's Monsters, Inc. Robert Iger, Disney's chief executive, disclosed those tidbits on a conference call with analysts. But there was no way around the quarterly results. Disney suffered declines in revenue and profitability at 3 of its 4 major divisions. Only theme parks had growth, albeit tamped down by Hurricane Irma, which closed Walt Disney World in Florida for 2 days and forced the cancellation of Disney Cruise Line itineraries. ABC and its sister production arm, ABC Studios, have suffered a dry spell. In the quarter, operating income at the division anchored by ABC fell 15% to $229 million, because of a lack of hits and lower political advertising at Disney's chain of local television stations. We've had some disappointments on the ABC side, but we've been focused on turning that around, Mr. Iger said. Some improvement from a quality aspect would be helpful. He added that he was encouraged by viewership for a new drama, The Good Doctor, which is produced by Sony Pictures Television. For its fourth fiscal quarter, Disney had net income of $1.75 billion, or $1.13 a share, compared with $1.77 billion, or $1.10 a share, a year earlier. Revenue totaled $12.78 billion, a 3% decline. Excluding one-time items, Disney had per-share income of $1.07. Analysts had been expecting slightly more. Disney's usual bugbear, ESPN, was also a factor. Disney said its cable networks group, which includes ESPN and has historically served as a growth engine, had operating income of $1.24 billion, a 1% decline. At ESPN, advertising revenue fell because of lower ratings. The cable sports giant also suffered continued subscriber erosion because of cord cutting. Higher carriage fees from pay TV providers helped offset declines. The losses were not as deep as they had been in prior quarters, Mr. Iger said of ESPN subscriber declines. We're heartened by that, Sports Illustrated reported on Thursday that ESPN was considering yet another round of layoffs. However, Walt Disney Studios had quarterly operating income of $218 million, a 43% decline. Underwhelming ticket sales for Cars 3, especially compared with blockbuster results for Finding Dory last year, contributed to the drop. Disney also wrote off nearly $98 million in development costs for a Jack and the Beanstalk themed it decided to shelve. Disney Consumer Products and Interactive Media had operating income of $373 million, a 12% decline, because of lower merchandise sales. Christine M. McCarthy, Disney's chief financial officer, said sales of Cars 3 toys had been a little bit lighter than we would have liked. That left Walt Disney Parks and Resorts to pick up the slack. Operating income in the division totaled $746 million, a 7% increase. Growth at parks in Paris and Shanghai offset the impact of Hurricane Irma on Disney World in Florida and Disney Cruise Line. Disney executives declined to answer analyst questions about recent talks, since ended, with 21st Century Fox about the purchase of television and assets. Ms. McCarthy did say earnings growth for the company's next fiscal year would be suppressed somewhat because of spending to build its services and increased losses at Hulu, of which Disney owns 30%. Disney also plans to increase its already significant spending on theme park attractions by $1 billion in 2018. A version of this article appears in print on November 10, 2017, on page B3 of the New York edition with the headline ABC: A Drag on Earnings at Disney.